What's up, guys? Today we'll look at the very important topic in trading, namely the risk management, and in particular with trading Bitcoin. And there are a few reasons why I'm making this video. First of all is that I believe that this is an important topic, and people, especially newbies in the space, they would profit from knowing some features, some things from this topic. And the second thing, I'm going to make some of the public trades in the recent future, near future, and probably this is like the very key point to those people who would like to do something like following the same trades, because like without the risk management applied to your own portfolio, your own capital, those would be very, very dangerous to do. Okay, so let's start with the main points. First of all, I would probably divide this into three parts: risk planning, risk-reward ratio, and position sizing. Well, you all know that, of course, we would have to lower our risk by at least putting some stop loss in order to avoid the huge drop in the price of the some asset which we buy expecting it will grow, for example, because if we'll go much lower, we might be in a very, very bad situation in terms of the cutting of our portfolio, our capital. So we'd have to eliminate it by setting the stop loss, and yeah, you will lose some part of your capital, but not as much as you might. So, and this is the thing about the risk planning. So the risk of your trading is basically the account size of your whole portfolio size, and multiplied by risk tolerance. Risk tolerance in percents, it's basically how much how big a portion of your portfolio you could you would allow yourself to lose for one trade. Sometimes it's just for one day if you day trade, but something like this. So let's say your account size is $1,000, and well, the kind of a widely accepted rule that you would better to stick at least with 1%, not more than 1% risk tolerance, and that would give you $10 as the maximum position, maximum loss on your trade. And then it would mean that you would have to do many bad trades in order to go to like nearly zero size. And you see, for example, if you'd have 1%, then if you'll have like 20 trades which are in a loss, then you would end up with having only 18% of your portfolio dropped. If you will have it in 2%, then you will lose a third of your entire account. If you will have 5%, then you will lose 2/3, and if you'll use 10%, then you would have only 88, or you have only 12% left after 20 trades, which would close with a loss. And 20% basically will kill your portfolio very, very soon. Moreover, of course, like it's not necessarily you will have all of them in a loss, but this is just an example showing you how important to keep this risk tolerance to the low value, because even if it wouldn't be that bad, if you have, let's say, 5 bad trades, it would mean that you would end up with only $4,000 after those 5 trades. And then if you have, let's say, 6 trades profitable, then it's not necessarily you will return to $10,000. So you see, it's a very, very important to keep this value at the low size, low number. Now the important thing, which is risk to reward ratio, and it's pretty straightforward. What you do is you have your maximum risk divided by your potential maximum reward in percent. Okay, so what you do is that you, let's say, you're going long and or short, and that's why you would have this absolute value here. And here is the difference basically for the total risk. It is entry price minus stop loss. And if you, let's say, buying Bitcoin for $10,000 and your stop loss at $9,000, then your total risk is $1,000. Okay, then total reward, it would be the entry price minus take profit, again in the absolute value, and since the take profit is higher for the long position, then you would have, let's say, $14,000 minus $10,000 will be $4,000. This is your reward, and risk to reward will be $1,000 divided by $4,000, 1 to 4. Well, sometimes it's reward to risk, so like 4 to 1, but in any case, of course, the lower this ratio, the better the trade. Then we'll look at this eventually with the certain examples on the trading chart, but now just let's look at the plain numbers. Well, first of all, you need to find some optimum value of your risk to reward, to not to have too much risk, but at the same time not eliminating the size of, not decreasing the size of your potential rewards. So there's also some kind of a balance and as well trade-offs here. And you see the important point here for the estimating your best risk to reward ratio is the number of the deals, the trades which you do with this ratio to remain profitable, at least not to lose money. And here is actually like reward to risk value, so it's the inverse metrics. But anyway, let's say you are having risk to reward 1 to 2, and it means that you need to do something like 33% of the trades in a profit, and then you would still be in at least not in the loss. And of course, if you will get the risk to reward ratio even better, then you would need to have less number of trades to be profitable in order to remain profitable overall. And of course, if you will make it this number higher, then with a better risk to reward ratio, you will be even in a better shape. So this is very important point. And the final thing, again, this is a kind of a cherry on the top of this cake. This is the position sizing. So the position size is basically the maximum size of your position which you can allocate for your trade, a single trade, or let's say the 1 day trading size and so on. So it is basically the size of your account multiplied by your risk. You remember we talked about this before, divided by the stop loss. So let's imagine again we have $1,000, our risk is 1%, and we divide it by, let's say we have a stop loss below our long position by 0.5%. It will be $10 divided by 0.005, $2,000. This is our maximum position size. And you will say like, hold on, we have the total account size only $1,000. How can we make $2,000 as a maximum position? So there you go with your marginal trading. So you can apply leverage to this position with such platforms as BitMEX or some others. And then what you can do is that you can have a position for your trade higher than your account size. At the same time, you will still be able to maintain the same risk strategy. And then what you can, how you do that is you will, again, for estimating your maximum leverage here, you divide your position size, which is $2,000, by the size of your account, $1,000. So this is the maximum leverage which you can get, which you can apply, right? And imagine you'd have this leverage, so then your max loss would be $2,000 multiplied by 0.5%, and this is $10, still 1% of your entire account size. Of course, you can use the smaller level leverage, and then it would just decrease your maximum loss, or it will like change your stop loss, whatever you like it. But if you will make it higher, so if you'll have your size of the position higher than $2,000, it would essentially make the leverage, well, you need to apply higher leverage, but it would bring the value of your max loss higher than the 1% value, which is again against the strategy for the risk management. Okay guys, I hope that it's more or less clear. So let's look at the actual examples. And you remember maybe I was covering this exchange SnapX, and in fact I will do my trades, which I will make public, and make those examples again on this exchange because of a few reasons. Well, first of all, you remember maybe yesterday it was a very like big change in the price. Let's say here for Bitcoin it was a very sharp rise and sharp drop, not to mention XRP. Well, people were saying like our stop losses didn't work, some people got liquidated and so on. So this happens on such platforms as BitMEX, and this is a well-known thing. And SnapX uses a different method to provide liquidity, so this kind of slippage doesn't happen on their platform. And so far, as many times I tried this platform and saw the performance, my stop losses, if they were triggered, basically no such a huge slippage I could find. Okay, this is one thing. And second thing is that the portfolio size is actually in the Tether values, so it's not in Bitcoin. And when you are doing your risk management, you better to go with dollars, at least for kind of traditional systems, traditional approach. So not necessarily it is better for everyone. Maybe you would prefer them to be in Bitcoin, but like I would say that you usually count your profits and loss in dollars. So this way is much more convenient than it's the same one, for example, on BitMEX. And you see it's very handy thing here for doing this risk management assessment. So let's look at some of the examples. For instance, you may open the short or long position here. Here you can find these tools. Let's say you're opening a long position and you have this position open at 10,190. You set your stop loss somewhere around here. You set your profit somewhere around here. So what you do is you're setting up your positions like this. That would be 10,180 roughly, and let's say 81. And then you set up your margin. This is the amount of the capital you will allocate to the trade, including your leverage. Let's say we set the leverage to 10, and then you see here is your loss. So if you'll set certain stop order, your loss will be $720. So what you can do is that you change your stop loss to what it is. Let's say $10,080. 10,000, let's say $79. It would make your loss at $90. All right. So still, it's higher than my 1% of my total capital, which is $8,600 here. So what you can do is that you need to decrease, make your stop a little higher, closer, tighter, or you can change your margin. So I would choose to change my margin to 800, and then you see my total loss, potential loss, would be $80. So I'm risking 1% of my entire account size. And then you set up your profit, let's say 10,400, something like previous high. If we were ranging 10,400, let's say 44, it would give you the profit of $200. So it's something about 2.5 in terms of profit to risk, and that's not that bad. I mean, it's not the best one, but again, if we're ranging, so why not to try to do this trade? So this is, but still, it's just an example how to do that. And let's say we are wanting to open the short trade. Okay, we are making a short position. We are setting the stop loss, for example, above the previous high, local high, and we're setting the take profit somewhere around $10,000, this round number, and we are going to open a short position at 10,200 and what it is, 37, let's say, and then we are having our margin $800, and our stop loss would be at 10,308. It would give us $55 for the loss. So we actually can increase our margin to make it a little bit more profitable if we will guess it right. 62. Okay, how about 1,000 margin? All right, it's 69. We can make it even higher. 1,200. Okay, $83. It's below 1% of the total equity. And let's say we're setting the stop loss at, as I say, 10,021. All right, and it will give us $250. So again, we are risking $80 here, but our potential profit will be $250. Of course, you can change it eventually. You can make your stop loss a little lower, and so on and so forth. Like if you'll make guesses right, then your position will go here, like the price will be here. You can move your stop loss to the place where you basically open the position, so you will be at least not in the loss eventually if you will guess it wrong, but your take profit can be also moved to a lower place, and so on. So guys, this is the way you are doing that. I hope that it's more or less clear. If not, please write your comments, so I'll try to explain that. But in this way, in this kind of a strategy, this kind of approach, I will publish some of the trades in the following videos as soon as we'll have some setups, so I'll think how to do that. And also, since we are on the SnapX exchange, I must say that we have a new campaign about giving away $100, up to $100 benefits, mostly for making some of the things on the platform, but like $5 entry, signing up, verification, I'll email your link, link your email, join the community, bonuses daily just for logging in. You have $1.5 only for checking your balance, and if you'll make the real trading with a volume of $100,000, you will get $70.5. And yeah, it will be only for 2,000 people joining the platform. Still, a lot of those remain. Go with FAQ. You need to see some things like you need to, let's say, deposit $50, although they can be withdrawn anytime again, but still, in order to be eligible for the bonuses. And some first 5 it's in dollars, and the rest are in snap points of the platform, but they can be converted to the USDT as well. So anyways, just take a look if you're interested. I will leave the my link for the platform in the description to this video, and yeah, I will try to find some interesting entries, some interesting trades for you in the following ones. And I hope that the risk management topic was interesting and useful for you, so maybe it will help you to be profitable in a long term. At least I hope so. Okay guys, that is it for today. Thank you for watching. Goodbye.